Thank you all for joining us for this money market funds discussion on the Gabelli podcast. This is Terry Pope, a member of GAMCO's institutional team, and with me is Judy Raneri, portfolio manager for the $1.6 billion Gabelli U.S. Treasury Money Market Fund and a GAMCO teammate for over 30 years. And for the next 15 minutes, I will host a conversation with Judy where we will discuss money market funds and the interest rate environment. Welcome, Judy.
Hi, Teresa. My pleasure to be here.
So let's begin with a recap. Can you explain what type of securities are typically held in a money market fund and how ratings are determined?
Well, money market funds are mutual funds that invest in instruments such as cash equivalent securities, and debt securities with a high credit rating and short-term maturities. These instruments offer high liquidity and relatively low risk, making them an appealing investment prospect of a well-balanced portfolio. So there are several types of money market funds, which vary based on the type of assets they invest in. There are treasury funds, which are 99.5% invested in cash and treasury securities, whose income is also free from state and local taxes, and that is also referred to being SALT-free. Our Gabelli U.S. Treasury Money Market Fund falls into this category. Government money funds that invest more than 99.5% of their assets in government securities and also have repurchase agreements as a secondary investment option. There are prime funds, also referred to as taxable funds, which invest in commercial paper, floating rate notes, government agencies, to name a few, and these carry moderately higher risk than a government money market fund and in turn tend to have higher yields. And lastly, there's the tax-exempt or municipal money funds that invest in tax-exempt securities to generate income that is exempt from federal or state income taxes. Currently, the money market fund universe totals $4.5 trillion in assets.
In 2020, in response to the economic impact from COVID-19, the Federal Reserve reduced short-term interest rates to zero and also instituted several programs to support financial markets. And these included the Money Market Mutual Fund Liquidity Facility and the Commercial Paper Funding Facility. Can you explain what the Fed actions were and how they help investors?
Well, the key goal of both programs was to support the flow of credit to households and businesses and enhance the liquidity and functioning of the financial markets during that very critical period of uncertainty. So let's discuss more significantly the Money Market Liquidity Facility. So during the first 2 weeks in March of 2020, when the effects of COVID were beginning to be really felt in the markets, prime money market funds faced significant outflow of assets, approximately $120 billion in outflows during that 2-week time frame. It was at this time that the secondary market started to struggle and show signs of illiquidity, making the liquidation process extremely daunting, not only for the fund complexes, but ultimately the overall market. To prevent an industry-wide run or chancing the possibility of a money market fund breaking the buck, the Federal Reserve established the Money Market Fund Liquidity Facility. And ultimately, this facility reassured money market fund investors that funds will be able to meet redemptions in the future, which in turn reduced the incentive for investors to withdraw preemptively. The facility was very successful, not only at slowing investor outflows from prime and muni funds, but also fostering liquidity in that sector of the market. The facility expired in March 31st of 2021.
So at the recent Jackson Hole Symposium, Fed Chairman Powell remarked that the Fed could start scaling back stimulus this year and indicated a possible tapering of bond purchases. So what are your views?
Well, Powell's keynote address this year cited improvement in both inflation and employment. And with that, he reiterated that the next step in the cycle is near, and the Fed could begin to taper before the end of the year. So he wasn't specific about the timing or speed of tapering, given he wanted to allow some wiggle room just in case there were changes in the economic environment. But he did reiterate that the committee is largely confident that the economy is on a favorable path in terms of inflation and employment. And although the Delta variant does present a near-term risk, the prospects are good for continued progress toward maximum employment, hence onto the tapering cycle. So based on statements from other central bank officials, a tapering announcement come as soon as the Fed's September meeting. If the Delta variant doesn't worsen or the economic recovery doesn't stall, we could definitely see the Fed exit the marketplace by the end of 2022.
So picking up on your comments from the beginning of the pandemic, since that time in March 2020, 10-year treasuries have risen as high as 1.7 at the end of March 2021, which is still low relative to historical averages, and it's now back to about 1.285. So can you talk a bit about interest rate trends and what to expect heading into year end? And do you see inflation as a concern?
Well, the bond market is not really following the script many had expected this summer, unfortunately, which would have seen interest rates rising on the back of a booming economy and rising inflation. Instead, yields on longer-dated treasuries have fallen and have settled slightly off their lowest level since early 2021. This in the face of what could be viewed as mounting confirmation of persistent inflationary pressures. Now, there are economists and other analysts have provided several reasons to try to explain this rationale behind the current low rates in a rising inflation environment. One being is that there's strong demand for corporate debt and treasuries, which is pushing long-end yields lower. Another theory is that the negative interest rate environment we see overseas in Europe and Japan is boosting the demand for U.S. debt, since the U.S. offers positive returns. Moreover, investors may be seeking the shelter of government bonds over rising fears that a return to normalcy could be quite a bit further out the curve than many had hoped a few months back. And there are those that just blame it on technical issues or fears that inflation will force the Fed to move faster to tighten policy, slowing the economy as a result. I really don't think this movement lowering yields is really saying anything significant about the condition of the economy. We just need to keep in mind that given our current backdrop, the exact timing and speed at which rates will move higher is an open question that will simply depend not only on the Fed's plan, the continual normalization of the economy, and when the Fed scales back its monetary support. What will be critical in this process is the Fed's ability to effectively communicate the plan to the market so that investors and rates adjust in a smooth and orderly fashion. As for inflation, it likely is going to remain a dominant factor in market behavior in the weeks and months ahead. It has surged well above the consensus forecast to multi-decade highs as the economy has rebounded dramatically from the depths of the COVID-19 recession, leaving two questions hovering over the market. How much higher can it go, and how much longer might it last? While core consumer prices have risen to a near 30-year high, Powell reiterated his stance he took before Congress earlier last month that higher inflation will prove temporary, and the committee will still, or is still, a long way from raising rates.
So thinking about institutional investors, are you seeing any changing trends in terms of liquidity management solutions? And what are your views?
Well, not really at this point. Obviously, many institutional investors have most of their value tied up in investments such as equities, real estate, and the like. But one needs to keep in mind there are many different factors you have to consider before making a commitment to any investment vehicle. If you invest in stocks, you have to bear the risk of market and economic volatility. Bonds carry with them both interest rate and inflationary risks. And most importantly, keeping an eye on changing markets is key. The right asset allocation depends on an investor's specific time horizon and risk capacity. For example, an investor who will need funds in the very near term might be better off holding cash or a cash equivalent investment. Bottom line, the right allocation or makeup between bonds, stocks, and cash linked to the investor's goals creates a well-balanced portfolio positioned to ride the ups and downs in changing markets while maintaining financial stability.
Thank you all for listening to Gabelli Media, and we look forward to you joining us for our next podcast. I must read the following disclosures following our podcast. Debt and equity investments are affected by market conditions, and the intrinsic value of securities in which our portfolios invest may never be recognized by the broader market. The opinions expressed are current as of September 7th, 2021, but are subject to change. The information provided in this podcast does not provide information reasonably sufficient upon which to base an investment decision and should not be considered a recommendation to purchase or sell any particular security. Portfolio holdings are subject to change. The performance of any single portfolio holding is no indication of the performance of this or other portfolio holdings of any strategy or fund. Comments made on any individual company or stock or debt security is not an indication that it is currently held in a portfolio, nor is it an indication that it ever will be held in a portfolio.
Investors should carefully consider the investment objectives, risk, charges, and expenses of the fund before investing. The prospectus, which contains more complete information about this and other matters, should be read carefully before investing. To obtain a prospectus, please call 1-800-GABELLI or visit www.gabelli.com.